The currency reset has started. This is real. And before this video is over, I'm going to tell you about a single stock trading right now at around $5 that I believe is one of the most strategically positioned assets you can own as this transition unfolds. It's not a meme stock. It's not crypto. It's not some speculative lottery ticket. It's a company sitting directly in the path of the most powerful, most documented, most historically inevitable money rotation the world's ever seen. And if you understand what I'm about to explain to you today, not just the headlines, not just the noise, but the actual structural mechanics of what's happening under the surface of the global economy right now, you're going to understand exactly why a $5 stock could be one of the most asymmetric opportunities of the decade. Now, before we dive in, the only thing I ask in return for all the work that goes into making a video like this is that you hit that like button and don't forget to subscribe. Every time you do that, YouTube pushes this video out to more people, which helps us prepare more people for what's happening. The United States is currently carrying more than $38 trillion in debt, and the truth is, by every historical precedent, the current system should already be under extreme stress and really collapsing at this point. Yet the USA, the country, continues operating as if nothing's wrong, and financial markets just keep hitting all-time highs while the real economy is deteriorating. In times like these, the best way to secure and maintain your retirement is to maintain a balanced portfolio that can ride through the economic chaos. With that in mind, I've developed a list of the best 6 stocks to own in 2026 that you can download for free at free.stockscommunity.com. If you're actively managing your stock portfolio, head over to stockscommunity.com to learn how I buy and sell stocks at the right time. I'm currently offering a completely free 10-minute training on how I spot stocks before they go up. This is the same training that one of our members watched and went on to make thousands of dollars in a day in our community. You can view this 100% free training at the link in the description below. As always, nothing in this video is financial advice. Do your own research. So let's start with the most important thing I want you to understand today. Currency collapses are not accidents. They never have been. And the one we're living through right now, slowly, deliberately, in plain sight, is no different. Every single empire throughout recorded history has told its people the same lie. They told them their money was stable. They told them their currency was safe. They told them the system was sound. And every single time, without exception, the rulers watched that promise crumble while ordinary people paid the price. Now, most people imagine a currency collapse as something sudden and dramatic. One day your money works, the next day it doesn't. You picture the images from Weimar Germany in the 1920s, wheelbarrows full of Deutschmarks, people burning currency for warmth because it was cheaper than firewood. And yes, that kind of end stage chaos does happen eventually, but that's the end of the story, not the beginning, and we're still very much in the middle chapters right now. In reality, currencies don't die overnight. They're debased and dismantled over time through reckless and deliberate monetary policy. The real collapse is engineered in slow motion. It's designed specifically to drain your wealth without you noticing until it's far too late to do anything about it. By the time the average person wakes up to what's happened, the insiders, the financiers, the central bankers, they've already positioned themselves in the new system. They're already on the other side of the trade. And that is exactly what's happening right now. Let's go back to Rome for a moment because Rome tells us everything we need to know. For centuries, Roman coins were made of pure silver and gold. They were trusted. The people believed in them. They represented real tangible value, but as the empire's costs spiraled out of control, endless wars, expanding bureaucracies, a government that never learned to live within its means, the emperors made a decision. They started mixing silver with copper, just a little at first, then more, then more. This is what monetary historians call currency debasement. The currency looked the same, it felt roughly the same, but over time it bought less and less and less. It was debased. The denarius, Rome's primary currency, eventually collapsed. Ordinary Romans, farmers, merchants, soldiers, working people, they bore the cost. Meanwhile, the rulers preserved their wealth, consolidated their power, and positioned themselves for what came next. This was not a mistake, this was a policy tool. It was deliberate currency debasement, executed strategically, and the people took this hit every single time. Then there's Weimar Germany. After World War I, Germany was crushed by reparations it literally could not pay. The government's answer was to print, and then print more, and then more. Within just a few years, The German mark became so worthless that workers were paid twice a day so they could spend their wages before inflation ate them by afternoon. Ordinary people lost their entire life savings. Businesses failed overnight. Livelihoods that had taken generations to build simply evaporated. But here's what the history books tend to gloss over. While regular Germans were being wiped out, politically connected individuals, financial elites, and foreign investors were sweeping in and buying German assets for pennies on the dollar. Factories, real estate, businesses, infrastructure. They were acquiring hard, tangible, real assets at catastrophically discounted prices, pricing everything in a currency that was collapsing, while they held stores of value that were not. What textbooks called economic desperation was in reality the largest wealth transfer in modern European history up to that point. Does any of this sound familiar? Let's bring this forward to the United States, because this story did not skip America, it just moved more slowly here, which made it harder to see. In 1971, President Nixon took the United States off the gold standard. At the time, it was framed as a temporary measure, a short-term response to economic pressures, a minor course correction. That was the story they sold, but in reality, that single decision fundamentally changed the nature of money in America. And because the dollar is the world's reserve currency across the entire global economy. Before 1971, the dollar was anchored to gold. There was a limit to how much currency could be created because you had to have the gold to back it. After 1971, that constraint was gone. The Federal Reserve, which, let me remind you, is not exactly federal, it doesn't hold reserves in the traditional sense, and is not a bank that any ordinary citizen can use, gained effectively unchecked power to create money. And they've been using that power ever since. What followed was decades of funding, ending foreign wars, ever-expanding government programs, repeated corporate bailouts, all financed through debt and inflation, and the cost of all of it fell not on the institutions that made the decisions, but on ordinary savers, on people who worked hard, put money in the bank, and trusted that a dollar saved today would still be worth a dollar tomorrow. It wasn't. It hasn't been for a long time. In 1997, the Asian financial crisis wiped out currencies across Thailand, Indonesia, and South Korea almost simultaneously. The official story blamed reckless borrowing by these nations, but if you look deeper at what was actually happening, international speculators and financial institutions were the ones triggering the panic. And it's not just the endless foreign wars and the aftermath. Just like Rome and Weimar Germany, foreign powers stepped in and bought assets at deep discounts. IMF programs were imposed that served global finance far more than the actual citizens of those countries. The playbook is always the same. Destabilize trust in the existing system. Engineer the crisis or let the structural pressure reach a breaking point. Then step in and acquire the assets that remain valuable, the real tangible things at fire sale prices. Meanwhile, regular people are left holding the currency that just got destroyed. This is not a conspiracy theory. This is observable, documented, historical fact. It's happened over and over again in different countries in different centuries under different names and different political systems. The details change. The mechanics remain identical. Now here's where it gets really important, because what's happening today is the same pattern, but it is bigger than any previous reset in human history. This is not a single empire debasing its currency. This is not one country in crisis. This is a synchronized global debasement of essentially every major fiat currency simultaneously. More than 40% of all US dollars currently in circulation were created in just the last few years. Think about that for a moment. 4 out of every $10 that exist in the world today were printed recently, and similar expansion has occurred across virtually every major economy on the planet. The European Central Bank, the Bank of Japan, the Bank of England, they all have expanded their balance sheets in ways that would have been considered unthinkable just 2 decades ago. And this is not a short-term emergency response that's going to be unwound. This is now a permanent feature of policy. Modern fiat systems require constant monetary expansion just to keep the debt-driven economies alive. The debt grows faster than real economic output. The liabilities exceed the ability to repay them. And so the only way forward, the only tool left in the toolbox is to debase the currency, to inflate away the debt, to make the liabilities cheaper in real terms by making the unit of measurement worth less. Central banks know this, governments know this, the Bank of International Settlements, the IMF, the World Economic Forum. They have all published reports, held conferences, and made statements that, if you read carefully and take seriously, tell you exactly where this is going. The system is being restructured, a new financial architecture is being built, and the transition from the old system to the new one is already in motion. We're not waiting for it to start, it has started. We're in it right now. When you understand the pattern, the signals are everywhere. Persistent inflation that never quite goes away, no matter what central banks claim to be doing about it. Asset prices, stocks, real estate, anything with intrinsic value, rising not because the underlying assets are suddenly more productive, but because the unit of measurement, the currency, is losing value. Your paycheck might go up. Your portfolio numbers might go up, and yet you still feel like you're falling behind. That feeling is not irrational. It's mathematically accurate. You're measuring your wealth in a ruler that is getting shorter. You're seeing geopolitical fragmentation accelerating, not as an isolated series of unrelated crises, but as interconnected symptoms of a monetary system under structural pressure. You're seeing sovereign debt reach levels that are no longer theoretically repayable. You're seeing countries quietly diversifying away from the US dollar, international trade settlements. You're seeing the petrodollar arrangement, which has underpinned dollar dominance since the 1970s, quietly beginning to unravel, and you're seeing something else. Something that, if you understand monetary history, should tell you everything you need to know about where smart institutional money is going. You're seeing the largest, most sustained shift into gold in modern history. Let me give you some numbers, because numbers don't lie, even when narratives do. In the year 2000, central banks held approximately 22% of all the gold in the world. By 2019, that number rose to 29%, a meaningful increase, but gradual. 7 percentage points over nearly 2 decades. Then something changed. In 2022, the Biden administration froze Russia's foreign currency reserves held in US dollars, essentially using the dollar status as the world's reserve currency as a geopolitical weapon. From a strategic standpoint, regardless of your politics, this was a warning shot heard in every treasury, ministry, and central bank on earth. The message it sent to every country that was not a close American ally was stark and unmistakable. The dollars you hold as reserves are not truly yours. They can be taken away. They can be weaponized against you if you step out of line. And the response was immediate. China, which had already been working methodically to chip away at dollar dominance, accelerated its efforts. Country after country quietly began pivoting their reserve management strategies. The petrodollar arrangement, the agreement that's kept oil priced in US dollars since the 1970s, began showing visible cracks as nations started pricing oil in yuan. International trade settlements began shifting, and central banks started buying gold. Not gradually, not cautiously, aggressively. In 2021, central banks were purchasing on average around 400 metric tons of gold per year. That was already a historically elevated pace. But starting in 2022 and continuing through today, that number doubled to 800, 900, sometimes over 1,100 metric tons per year. The largest central bank gold accumulation since the gold standard era. By 2025, central banks collectively held 47% of all gold in the world, from 22% in 2000 to 47% today. That's not a historical statistical blip. It's a tectonic shift where the sophisticated institutional capital allocators are choosing to store value in gold. Smart money, the most informed, best resourced investors in the world, voting with their balance sheets that gold is where value goes when fiat currency is under structural pressure. JP Morgan has put out price targets for gold of $6,300. Bank of America raised their targets to $7,000. Some credible analysts are talking about $8,000. These are not fringe predictions from YouTube channels. These are the largest financial institutions in the world looking at the same supply and demand dynamics, the same central bank buying patterns, the same monetary policy trajectory, and concluding that gold has significantly further to run. And here's why this matters so much. The demand for gold is not a speculative bubble. It's not a narrative driven by social media enthusiasm. Gold demand is driven by 3 stable, enduring forces. Jewelry consumption, particularly in Asia, where cultural attitudes toward gold as a store of wealth are deeply embedded and growing stronger as middle classes expand, accounts for roughly 50% of annual demand. Industrial and technology uses account for another 10%, and the remaining 40% is investment and reserve management. That last category is the one that's been accelerating dramatically, and there is no credible reason to believe it stops. As US debt continues to climb, as monetary policies continue to expand the money supply, as geopolitical fragmentation continues to push nations away from dollar dependence, the structural case for central bank gold buying does not weaken, it strengthens. Every day that passes without meaningful fiscal discipline from Washington, every additional $1 trillion added to the national debt, every new geopolitical conflict that demonstrates the risk of dollar-denominated reserves, all of it is fuel for continued sustained institutional demand for gold. Now, let me bring this all together because understanding the macro picture is only half the battle. The other half is not macro, it's knowing how to position yourself to benefit from it rather than being destroyed by it. History is very clear on this point. Those who survived and thrived during monetary resets were not the ones who held cash. Cash is the only thing that's guaranteed to lose value when currency debasement is the policy. Savings accounts, money market funds, bonds denominated in a currency being actively debased, these are not safe havens. They're the mechanism through which wealth is transferred away from ordinary people and towards those holding real assets. The people who came out ahead in Rome, in Weimar Germany, in every historical reset were those holding tangible assets with enduring value, real estate, productive businesses, precious metals, things that retain value regardless of which currency system rises or falls, because their value is not dependent on any government's promise. Gold has played this role for thousands of years. It's outlived every empire, every currency, every political system that has ever tried to replace it. And right now, in this moment, with central banks accumulating it at historically unprecedented rates, with institutional price targets suggesting substantial upside, with the monetary backdrop as favorable it's ever been for gold appreciation, the question is not whether gold is going higher. The question is how you get the most effective exposure to that move. You can buy physical gold. That's a legitimate strategy and one that has merit. You can buy gold ETFs, but if you want leveraged exposure, if you want a vehicle where a move in the underlying gold price translates into amplified gains for your portfolio, then gold mining stocks deserve your serious attention. And that brings me to the specific opportunity I want to talk about today. B2 Gold Corp, trading under the ticker BTG. It's currently priced at around $5 per share, give or take. And I want to walk you through exactly why I believe it's one of the most strategically positioned assets you can own in this environment. First, let me explain who B2 Gold is, because the fundamentals matter as much as the macro story. B2 Gold is one of the largest low-cost gold producers in the world. The company operates major mines across multiple continents with flagship operations in Mali, Namibia, and the Philippines. They have a long track record of operational excellence, consistent production, and disciplined cost management. It's not a junior exploration company hoping to find gold someday. It's an established cash-generating gold producer, a company that pulls gold out of the ground every single day. Now, here's why that matters so much in the current environment. When the price of gold rises, gold mining companies do not just benefit proportionally, they benefit disproportionately. Here's the math. If a company mines gold at an all-in sustaining cost of, let's say, $1,200 an ounce and gold selling for $2,400 an ounce, their profit margin per ounce is $1,200. If gold moves to $3,000 per ounce and their costs stay roughly the same, which they often do, because mining costs don't move in lockstep with gold prices, their margin just jumped to $1,800 per ounce. That's a 50% increase in profitability on a 25% move in the gold price. That's the leverage that gold mining stocks provide over simply owning gold itself. B2 Gold has maintained some of the lowest all-in sustaining costs in the industry. That cost discipline means that as gold prices rise, an increasingly large percentage of every additional dollar in the gold price flows directly to the bottom line. The operational leverage is significant. Let's think about the valuation. At around $5 per share, BTG is trading at a level that, when you look at the company's production profile, its reserve base, cash flow generation, and current and projected gold prices, that appears substantially disconnected from what the underlying business is actually worth. There are periods in the market, particularly after gold stocks have been out of favor, after investor enthusiasm has drifted elsewhere, where excellent companies get mispriced. I believe this is one of those moments for BTG. The broader market's been slow to price in the gold bull case fully, even as gold itself has moved significantly. Many gold mining stocks, including BTG, have lagged the metal. This is not unusual. Mining stocks often underperform gold during the early stages of a gold bull market, and then they catch up aggressively, often dramatically outperforming the metal when the narrative fully takes hold and capital starts rotating in earnest. And that rotation is beginning. When JP Morgan talks about $6,300 gold, when Bank of America puts out $7,000 targets, when central banks are buying 800 to 1,100 metric tons per year, when every structural force in the macro environment, monetary policy, geopolitical fragmentation, debt sustainability concerns, the slow motion restructuring of the global financial system is pointing in the same direction. Capital starts to flow. Portfolio managers start allocating to the space. Retail investors start noticing. Momentum builds. A $5 gold producer with BTG's operational track record, cost profile, and reserve base is exactly the kind of company that catches a bid when that rotation accelerates. It has the market cap that institutional investors can meaningfully build positions. It has the liquidity they need. It has the production profile that gives real exposure to the gold price. And it's priced right now at a level that I believe significantly undervalues what the business is worth at today's gold price, to say nothing of where gold appears to be heading. There's also a dividend. B2 Gold has historically paid meaningful dividends, returning cash to shareholders, something that distinguishes it from many smaller gold producers that consume capital and growth and exploration. A cash returning, low cost, large scale gold producer at $5 a share in the early stages of what appears to be a sustained, institutionally driven gold bull market. It's the kind of setup that patient, informed investors look for. It's not a stock you buy hoping for a pump next week. This is a position you build because you understand the macro forces at work, you believe the gold thesis is durable, and you want a vehicle that provides genuine leverage to that thesis at a price that still makes sense. So, here's the hard truth that I want to close with, because it's the most important thing I can tell you. The window to position strategically in a monetary transition does not stay open forever. This is not me fear-mongering. This is simply what history shows over and over again. The wealth transfers that happen during currency resets are not sudden events that give you time to react. They're processes that unfold gradually and then towards the end very quickly. By the time the narrative's on the front page of every newspaper, by the time the YouTube algorithm is flooded with gold content, by the time your brother-in-law is asking you how to buy mining stocks at Thanksgiving, the opportunity compresses significantly. We're not there yet. We're still in the phase where most people are distracted by other noise, the tariff fights, the political theater, the daily volatility of the stock market. All that's real and none of it's irrelevant, but it is also in a very meaningful sense this sideshow. The main event is the structural shift in the global monetary system that's been building for decades is now entering an accelerated phase. Smart money sees it, central banks see it, they're buying the evidence. It's on their own balance sheets. I mean, JP Morgan sees it, they put a number on it. The historical pattern makes it clear. So what you do with the information is up to you. I can tell you what I believe. I can show you the historical pattern. I can point you to the data, but I cannot make the decision for you. What I can tell you is this. Those who come out of monetary transitions having preserved and grown their wealth are not the ones who reacted to the crisis after it became obvious. They're the ones who understood the pattern, positioned themselves in real assets with enduring value, had the conviction to hold when the noise got loud, and were on the right side of the trade when the wealth transfer completed. Gold's not just a commodity at this moment in history. It's a vote of no confidence in the fiat monetary system, and it's also a vote being cast simultaneously by central banks and institutional investors and increasingly ordinary people who are beginning to feel in their daily lives what the data has been showing for years. And BTG, B2 Gold, at approximately $5 per share, it's one of the most compelling ways I see to get direct leverage exposure to what I believe is still in the early to middle innings of a historic gold move. So what did I miss here? What would you push back on? Let me know in the comments. And if you're managing your portfolio independently and want to know how I spot stocks before they go up, watch my completely free training at stockscommunity.com, where I go over the same methods I teach my students on how to find the best stocks, spending just 10 minutes in front of their computers a day. And if you already have a portfolio going and you want to make sure you're in the best stocks in the market, Download my best 6 stocks to own in 2026 for free at the URL free.stocksme.com. If you found this information valuable, smash that like button, subscribe to the channel, and share this with somebody who needs to hear it, because the people who prepare themselves and stay one step ahead of the everyday person will always come out ahead in the long run. Do your own research, understand your own risk tolerance, talk to a financial advisor if you need one, but do not let the noise drown out the signal. The currency reset has started. This is real. And the question of whether or not it's happening, the question is not that, it's whether you're positioned for it. Thank you for watching, and I'll see you in the next one.